Okay, folks, welcome to Sunday Night Futures Live. This is Bob Desmond, and the markets are open. A brand new week. Happy Independence Day. And let's talk about the opening futures action here. And then we're going to talk about the big, beautiful law now, not a bill, the law, and what it might mean for the markets. Now, I'm not going to spend a lot of time talking about the provisions. You can see thousands of videos on it on YouTube. I'm going to be showing you what I'm going to be looking at, what barometers I'm going to be looking at to tell me which way this market is going to moving forward. Will it sell the news, or will it continue up higher? When will we know whether or not this market is about to poop out? And when will we know when it's time to buy? So we have the futures that are open right now. I'm letting them settle down here a little bit. And let's say hello to folks. I see my good friend Franklin here. Hello, Franklin. Welcome. We have Mr. Tim. I love to do it. Thank you for being here. It's an honor. All I can ask is like, subscribe. You know the deal. Sean, welcome. Okay, so we have the E-minis up. I should say they're off the lows. They're not up. They're off the lows at current. Now, I'm getting the vibe here that what they're doing is that they're counting. Let's go to a daily view here. No, this is Friday. So we are down. Yeah, what they're doing here is that the last day, the daily chart shown was the 3rd. That was a trading day. What they're not showing here is on a daily chart is the price action on Friday. The futures markets were open. It's not reflected here on a daily chart. If you go to a 15-minute view, you can see that on Friday we were down. We were down about 0.6%, a little bit more than that on both the ES and the NASDAQ. And you can see it here. Boom. It's just not being reflected on the daily chart. So what they're trying to do is fight it back. It's showing as negative here, down about 1/3 of a percentage point. We're off the lows of the session. So net relative to the last trading day, we are down at current. This number up here is accurate. Just don't use the daily charts on if you're using Thinkorswim right now anyway. Let's take a look at the NASDAQ. The NASDAQ as well, down about 1/3 of a percent relative to the close on the 3rd. Now, what I want to do here, I'm probably going to go back to the NASDAQ, excuse me, back to the S&P 500. And I want to set up some alerts. Do we put in higher highs? Or do we break to new lower lows? I don't need to type in anything. Let's go back to the E-minis for a moment. Okay. So now we are not beholden to watch the chart. We can let the alerts do the work for us and check back in. Let's go to the small caps for a moment. That's the RTY. Russell 2000. They're also down about 1/3% relative to the close on July the 3rd. EMD, which is the mid-cap sector, that's doing a little bit better. That's down only about 1/4 percentage point. Not much volume here. You could tell by the lack of movement. So, long story short, as we begin the new trading week, we are down at the open. We are off the lows relative to the close on July the 3rd. Why? The reason that we were down on Friday was concerns about trade talks with the Chinese. I posted an article into ChatGPT. I'm going to walk through this really quick just so I can get this out there. Global tensions escalated. China pulled out of a part of a scheduled EU summit and slapped anti-dumping duties of up to 35% on EU brands. What else do we have? Some see broader risk. Bank of America's Michael Harnett has flagged the S&P 500 is approaching bubble territory. With the recent surge, it may be due for a pullback. He suggests trimming exposure beyond the 6,300 mark on the index. Lastly, Trump warned that he might impose unilateral tariffs as high as 70% on various countries, starting immediately, with roughly 10 to 20 being sent to trading partners ahead of the July 9th deadline. So remember, we've been waiting for this 60-day cooling off period for deals to be reached with a number of countries. We don't have much. So we could be seeing a little bit of risk being priced back into the equity markets due to tariff concerns. And plus, let's not forget the valuations of the market, which we're going to be talking about quite a bit tonight. Let's move on over to the US dollar. The dollar's down at current. I'll tell you, I'm looking at this chart here. Looks like it wants to go up. Very tight Bollinger Band squeeze. My guess is they turn this positive, assuming that they close this 15-minute bar strong as it is right now. Let's set up an alert. See what happens there. All right, let's check back in with other currencies. We'll go to the euro. The euro had a very good week last week. It's coming off of its highs now, but still up 0.20%. As for the Japanese yen, not a great open here at all. Again, this is feeding on that July 3rd price action. Everything is relative to that closing price action. It's not really factoring in that much the Friday price action. So we're up at current, including Friday. But right now at the open of Monday, we are down on the yen and also on the euro relative to the US dollar. For whatever reason, the US dollar is not positive, which is strange. It should be positive. I guess relative to the close on Friday, it is. So looks as though the dollar is probably going to move up higher here. Let's say hello to folks that just joined in. Larry, the AI bubble will burst when tech companies disappoint on earnings. It's coming in 2025, not 2026. I wouldn't be the least bit surprised at all. Denny, welcome, sir. Talon, welcome. Hi, Bob. Happy Independence Day, everyone. TZ Burton, happy Independence Day to you too. Bob, does the VIX only reflect options activity or shorting of equities as well? No, the VIX The VIX is a contract on volatility, so it should theoretically trade inversely of the S&P 500, because basically being long of a VIX contract is technically being short of the S&P 500. But that's not always the case. I mean, you had an up market last week on the VIX index, perhaps not the front month contract, but the S&P 500 was up as well. So what that means is if you see them S&P 500 up, VIX up, all that means is that you have institutions out there that remain long of equities, and they're hedging now. They're buying VIX contracts as a hedge. So why they wouldn't buy SPY puts or SPX puts, I don't know. But that's for brighter minds than me to figure out. But no, it doesn't reflect the shorting of equities. I guess if you have enough shorts out there and you're breaking key support levels in the bearish downtrend, then yes, de facto, it's going to drive up the VIX because you're breaking support. Everybody's out there chasing protection against the downfall. So it can have an influence. But right now, no, you don't have a lot of shorting going on right now. But you do see the buying of VIX contracts as a hedge. The market loves it. AMD. Okay. Tony, welcome. You are welcome, my friend. All right. So the article I just referenced, I'm going to send you my information so you have it, my sources, so you don't think I'm pulling it out of my hat. Okay. Let's move on to commodities. I think energy is important here. We had an announcement, I believe it was on Friday as well, that the Saudis and OPEC would increase production in August. And yeah, you're seeing a pullback now of about 1.75% on crude oil prices. Let's check in with natural gas. Natural gas down 2%. That sounds like a lot on natural gas, but really it's not. We've seen natural gas open up 7-8% at times, or down 7-8%. So it's a measurable move, a significant move, but it's natural gas. So we don't think all too much about the 2% move. Silver driving up higher here. Wow, big move here at the open on silver. We're up nearly a percentage point. This is now a 15-minute chart with only 2 minutes left in the bar, and this is one powerful chart. Let's go to a 4-hour view to get a vibe for the setup. Wow. Great 4-hour consolidation on silver. We broke out on Friday in the morning. Remember, it was an abbreviated, the futures broke out. My apologies. The futures broke out on Friday, even though it was Independence Day. The futures markets were open a portion of the day, and they broke silver out. Now we're getting a continuation breakout on silver. Let's see what they're doing with gold prices. Gold prices up fractionally. Let's just keep in mind that gold has had a heck of a run. Silver, not so much. The silver-gold ratio, there's a lot of room to make up for silver to close the historical gap with gold. So no great shock that you're seeing silver move up with gold not doing all that much. I do want to check in with palladium. We opened up a position on palladium about a month or two ago. And palladium's treating us really, really well at current. I think this is going to play catch up. We could also take a look at platinum. Platinum is PT. No, that's palladium. PT. Oh, what's platinum? I'll figure it out. I will figure it out. PL. Wow, platinum moving up here at the open, 1.85%. Strong move, good looking chart. Let's go to the 15-minute view. We're off the session highs. I think this continues up higher. You do have Stokes rolling over here a little bit, though. May not be a straight shot up higher. We did energy. We did precious metals. Let's check in with copper. Copper's had a nice run. That is moving lower. Let's go to a weekly view. That's moving lower at the open. I think we're breaking out here on copper. Look at this base, a multi-month base on copper. We may get a pullback to around $5 a pound on copper, but I think ultimately this is going to get resolved to the upside because I think we're going to get more inflation. Hate to be that guy, but I am that guy. Let's go to weekly view. Let's check out agriculture, ZC. That's corn. Sorry about that noise. Corn, this is a weekly view. This is not this week. This is last week. Corn, really nice reversal bar on the week last week. I'd be a seller of puts on the futures. I'd be a buyer here of corn. I think that this is a really good setup. If you're going to buy the futures or you're going to buy call options, I would go, at least 90 days out. If you're going to buy the options, if you're going to sell puts here, 45 days out. But I think that corn is setting up for a nice rally here. Very, very nice setup. ZW. It had a rough prior week here, but here's the thing, is that you always want to, do we have new lower lows, which yes, we did intra-week, but we did not have new weekly closing lower lows. So how I look at this is that this is a new trading range on wheat. Would I buy it here? Probably not. Perhaps on a breakout above this little wedge formation that's forming, I would be a buyer. Would I sell puts here? Yes. Last ag play up is soybeans. Soybeans, a meh week last week. Not much to talk about. Z. LE is what I want. LE. That is cattle. This looks actually pretty good. It broke out the week prior to last. Bullish reversal bar. Continuation breakout last week on cattle. I got to say, it's looking pretty good. I was hoping for a double top and a breakdown. We could still get the double top. I don't know about the breakdown yet. That's going to take a while. I was out to dinner on Thursday night. I got my New York strip. God damn, good cut, great steak, but man, it was expensive. Michael, which is the best sector or which company would you invest into copper? Which companies? Well, you're saying in copper, so the copper is a sector in and of itself. So I would be looking at Southern Copper. I would look at BHP Billiton. Those are the two names that come to mind when you talk about copper to me. TF Hatter, welcome. Welcome, my friend. Okay. So we have the 10-year yield, which we're going to talk a little bit about later on. The 10-year yield is down at current, and we have volatility. This is a 4-hour chart, which gapped down. I'm trying to understand this chart. It's showing up, but it's down relative to the close on Friday. This is wrong. Candlesticks are right. Volatility is down. Okay, let's get to it. Let's talk about the coming week. Let's talk about valuations, and let's talk about sentiment and the big, beautiful law. No longer a bill, a law. And again, I'm not going to go what's in the bill. I'm not going to do it. I know by and large what's in the bill, and we'll talk about that in a little bit. But first, we want to get to what pays the bills, and that is TrendSpider, folks. They're doing the Independence Day sale up to 50% off. Head on over. Use the link below on YouTube, link above on Facebook and Twitter. Head on over and get that discounted savings. Do not use my discount code. That only gets you 35% off. Use my link. Head on over. They'll walk you through it. Get your bigger discount for Independence Day. I appreciate the patriotism of our friends over at TrendSpider. Great folks. We'll be demonstrating the product in a little while. So with that, let's move on. Let's talk about the data that came out last week in terms of economics. We had some good numbers, I got to say. We had let's go to Tuesdays. We had the manufacturing PMI that came in with a beat. Construction spending came in a little bit worse than expected. ISM manufacturing came in with a beat. ADP employment report. Here's where things got a little bit sticky. A big, big miss on ADP. Then on the 3rd, we had non-farm payrolls, the pimp mac daddy of them all in terms of economic data. And we beat by a mile. Here's the catch. While we are seeing, it's hard to see here. I had full access to this a moment ago. Now they have it against a paywall. Private sector only added 74,000 jobs. The remaining jobs that were created were all state and local, not federal, state and local. So when you take a look at this number, and I'm not looking to insult anyone, that's not my goal here, but private sector creates. Government takes away. So they're not producing anything. They're not producing anything. So when I look at that number, I say to myself, that's pretty discouraging that we only got 74,000 private sector new jobs, and we have an equal amount of state and local government workers that were added to the payrolls. That is very, very disappointing. Now, for a change, from what I understand, is that they did not revise down prior reports, which is a big change. From what I understand, and if somebody's got different information, please share it. But for the past 5 or 6 years, all we've seen are headline beats on jobs data, and then the prior month's reads get revised down, not by a little bit, but a lot. And the Federal Reserve right now, when you take a look at the unemployment rate, which ticked down last week, as one might expect, to 4.1% versus expectations of 4.3%, why would they cut rates? Why? So with this report, the expectations for a Federal Reserve rate cut went from, in July, about nearly 25% down to 4.7%. For September, probability of a cut was over 80%. Now it's a coin flip at 65.5%. Even October, which is at about 99% probability of a cut, now down to 88%. Keep that in mind, because the president is jawboning Fed Chair Powell to get them to cut rates. As much as I respect the president, I want him to succeed, if I'm Jay Powell, I'm not cutting rates. There's no way. Why would I cut rates? You're reporting that you have job growth, which is strong. Granted, wage growth came in a little bit less than what was expected. However, you're passing a huge spending bill. You're going to put more money in the pocket of people. Those people that are going to get that money by and large with the savings on taxes, on tips, uh, on overtime, they're going to go out and spend that money. So what's going to happen is a repeat of the COVID era, not to this great of extent, where you have a lot of money floating around out there, not being invested, but being spent, chasing too few goods. So if I'm Fed Chair Powell, I'm worried about inflation, not about jobs. My two mandates are to watch out for inflation, manage inflation, and jobs. Jobs are good. Therefore, I'm focused on inflation. And if the government's reporting bad data, then shame on them. Now, in terms of economic data coming out this week, we have this is a small business, and it can move the market, the small caps anyway. NFIB Optimism Index. We get the Fed minutes coming out on Wednesday. I don't expect much out of that, but you never know. Thursday, initial jobs claims we get that. There's not much in terms of economic data coming out this week. So we don't have much in terms of earnings. We don't have much in terms of economic data. So absent headline volatility on the trade front, I don't know why the path of least resistance, which is up, should not remain to the upside. That does not mean that with every point that we close up higher, that we don't come closer to a precipice. We are very, very expensive. We're going to talk about that right now. We're expensive in terms of valuation and in terms of sentiment. And as much as I hate to quote CNN, this is actually a pretty good read that they have out. Where is it? Right here, the Fear and Greed Index. This is from April 4th and July 4th. S&P 500. I mean, this is a huge move. And this was an accurate read back here. Now we're in extreme greed territory. And if you take a look at the sentiment indexes on the NASDAQ, on the S&P 500, they're nearing levels where you should become a little bit concerned. They're not nosebleed levels whatsoever yet, but it appears as though by the closing price action on the charts of them last week, I went over this with members on the weekend commentary, that they could proceed up higher, and there's more room for this market to move up higher. I'm not calling for a crash this week, but I am going to expect a major correction in the next couple of months. Now, moving on to valuations. This is somewhat inaccurate. And I reposted this, and I kind of regretted doing it. In fact, I'm going to unrepost this. The Shiller PE ratio on the S&P 500 is higher than it has been 96% of the time in history. Extremely expensive. Yes, agreed. The price to the last 10 years of earnings average adjusted for inflation is 38 times the second highest price since the dot-com bubble. It's possible, but when I'm using his initial baseline here of the Shiller PE ratio, and when you take a look at it relative to the prior high in October of 2021, we still have more room to run to take out that prior high. I think we are probably going to take it out. And God forbid we head up here to the 2000 highs. I mean, God bless us all. There's going to be a rude awakening for the markets, especially if inflation kicks up. So, yes, he's accurate. We are very expensive. This is the Shiller PE ratio. If you want to take a look at the Buffett indicator, extremely expensive. We are off the highs. You're going to see tweets out there, articles out there that we are at the highs of history on the Buffett indicator. We've come off some. So we don't want to be hyperbolic here. We want to be accurate. We are off the highs. We have just come off the highs, but still, relative to the historical trend, we are quite expensive on the Buffett indicator. And those are trailing metrics. And when you take a look at the data out of FactSet, the forward 12-month PE ratio for the SPX is 21.9, which is above the 5-year average and above the 10-year average of 18.4. So on a trailing basis or a forward-looking basis, it's an expensive market. So be careful. All right. So we know that with the economic data that's been coming out, in terms of jobs anyway, that the Federal Reserve has no real case to cut rates. So I'm not in that camp that believes that the Federal Reserve is going to come running in to save the day if we get an orderly pullback in the stock market. Trump can't fire Powell. I guess he can fire him, but it'll be a poop storm if he does that. So I don't think it's going to happen anytime soon. We have another year with the Fed chairman, and I don't necessarily disagree with the fact that he's rolling off debt off the balance sheet and he's not cutting rates. So the charts that I'm going to be looking at to tell me whether or not we are nearing troubled waters is first the CRB commodity index. Last week, we had a bullish key reversal bar. Only a few weeks ago, 3 weeks ago to be exact, we were nearing a major breakout. This is a beautiful saucer with handle, cup with handle, whatever you want to call it cupcakes. It's a beautiful consolidation. And it appears as though the CRB commodity index is getting ready for a rip your face off rally. Now, we know that crude prices are down at current about 1.75% at the open because of the OPEC production increases coming out in August. But if you believe, as I do, that the bill that was just signed into law by the president is going to have a short-term stimulative effect on the economy, meaning increased depreciation on investments into your business, capital equipment, that's going to have an immediate effect on the economy. That's going to be like, it's like pumping adrenaline to the economy. And you could see commodity prices move up higher in terms of especially industrial metals. And a rise in industrial metals, a rise in energy demand, well, that's going to take precious metals along with it. It's probably going to drive down the U.S. dollar. Here's the problem with the decline in the U.S. dollar. We'll go to that in a moment. I don't want to get out of sequence here. So watch out for the CRB commodity index. That's telling you it's a basket of commodities. If it's breaking out to new all-time highs, bet your bottom dollar the Fed chairman is looking at this and saying, I can't cut rates. I can't cut rates. It's impossible. Now, this is the 10-year yield weekly view. The price action here last week was not bearish. It was bullish. So I'll be looking to this. If you begin to see the 10-year yield begin to take out higher highs of 4.6%, 4.7%, I would be worried about us taking out 4.8%, a 5-handle on the 10-year yield, because don't forget what the trend is, the macro trend. Let's go to a quarterly view. The trend is up. We've hit a wall here, but man, if this breaks out and we break through a 5-handle on the 10-year yield, I don't want to own stocks. Maybe some high quality, low dollar, low valuation names that have gotten beat up, but I don't want to own AI. I don't want to own any of that stuff. I want to be very, very careful. And when you take a look at the Federal Reserve's balance sheet last week, it did nothing. It's flatlined. The trend is clear. It's defined. It's down. The Federal Reserve does not have the president's back at all. They're not cutting rates. They continue to roll off debt off their balance sheet, which makes the 10-year yield move up higher. Now, what's also going to cause a problem for inflation making a resurgence is the US dollar dropping like a rock. To be fair, so is the Swiss franc, Japanese yen, euro, dollar. All of these names, these, I got suckered into that one. All of these fiat currencies are losing value. The problem for the US, which is the world's reserve currency, is that we import a lot. And if you're going to import a lot, it's going to take more dollars to buy those imported goods unless you produce them at home. So that's inflation. Every time you see the US dollar drop, think about import prices. They go up, de facto up. Let's take a look at Paper Chaser. I plan on going over UNH in a little while. We own it, and we'll be talking about that. Okay, CopEx comes to mind regarding copper. Thanks, Talon. TF Hatter, silver, great company. PAS, yeah, great company. Okay, Clove, nice. Powell will retire, take his farewell wave, and let Trump pick a successor. Yeah, probably. Powell not leaving, and if so, when? He's got about a year left in his term. Bob, so do you think a correction will happen in the near future? I think you can get a sell the news event. I think that I think that this law that's been passed is going to be short term stimulative for the economy. Again, you get if you're a business and you've been waiting to buy computers, or if you're a construction company and you've been waiting to buy Caterpillar equipment, John Deere equipment, you want to see whether or not you can get better terms under the new law. Guess what? You just got it. They're not going to sunset provisions where you can write off 100% of the depreciation of that asset year one. So there's a lot to like in the bill. The problem is the longer term impact on the economy. That's the problem. So I'm not sitting here saying that, tomorrow the stock market's going to crash based upon increased spending. I'm not saying that. You could have said that 5 years ago. You could have said that 10 years ago. But what I am saying is that if you see the US dollar going to free fall and you get the 10-year yield ripping up higher to a 5 handle, we got problems. We got serious problems, especially with the CRB commodity index ripping up higher. That tells you all the story you need to know. The Federal Reserve will not come to help, and in all probability, to satisfy the inflation, you may be looking at a Federal Reserve that's got to increase rates. You are quite welcome, Paper Chaser. Welcome. Okay, what else are you looking at? So, amongst all these charts, you want to take them as a collage, okay? Just because one goes up, one goes down, really doesn't mean anything. You want to see it's like an orchestra. You want your trumpets over here, violins over here. Everything comes together and creates that music that we all love. The same thing with charts. You're looking for confirmation, and if you get the U.S. dollar, which crashes through right now, critical support, multi-year support, decades-long support of a trend channel. If we breach that and move lower like we did on the TLT, the 20-year bond, about 4 or 5 years ago now, it's not going to be good. You're going to see gold respond, and it's going to respond up, very much so up. And that goes for silver. When I say gold, think silver, think platinum, palladium. Anything you can drop on your foot and it hurts, it's going to go up. That is inflationary. Another chart you want to take a look at as well is the high yield debt market, which hit, I believe, all-time highs last week. Very powerful chart. As long as this remains strong, equities can move up higher. Now, the macro picture, Charles Bellio always puts out good stuff. Over the last 17 years, U.S. stocks have gained 592% versus 140% for international stocks and only 93% for emerging markets. Think about that. To me, I don't hear that I should short U.S. equities. What I hear is I should be buying more emerging markets because that's where the money's going to flow, especially if the U.S. dollar breaks down further, because that's like a tax cut for emerging markets. Here's the quarterly chart of the U.S. dollar. This is a train wreck. That's the support level I'm talking about. This trend goes all the way back to the financial crisis. And we are about to potentially break it. We have our double top. There it is. We have our confirmation breakdown. There it is. Does this hold? Do we break down and move towards the next price support level, which is at around 94 on the Dixie? And I think it's going to happen. Long story short, you need to watch the bond market and the currency market. That's going to tell you which way the stock market's going to go. Trump announced that tariffs are going to affect. Oh boy. This just came out, Franklin? E-minis are pretty much unchanged if this news just came out. Frankly, it looks as though they are basing here and may want to move up higher. Which markets or stocks do you like the best? I like emerging markets. I think that I like precious metals, and I like emerging markets. Ex-China. I'm not a China fan. You could have vertical exposure to China being long of emerging markets. So if China goes up, they'll do well, and you're diversified out of the United States. So EMXC is an ETF that you may want to take a look at. That's emerging markets ex-China. We own it. And it's on a tear right now. All right, let's do some chart requests, and we will call it a night. All right, I want to go over UNH first. I get a lot of inquiries about UNH. We did some videos on this a couple of months ago now, and we were buying it down here, and we still own it. But last week was not a good week. One of their competitors, which I had never heard of, came out and they pulled guidance last week. And UNH has already pulled guidance. Now, the response from UNH, as noted by this weekly candlestick, was not wonderful. I mean, early on in the week, I was counting my nickels and my dollars. I was feeling great. And by the end of the week, I was like, Jesus Christ, this is not good. I was about to go into damage control. So we're still profitable here, but I am a bit worried about the price action on UNH from last week. So what I think could happen is that we could pull back to around $300 a share again. Now, if we break that support level at $300 per share, close down below it on the week, I think we go lower. So I'm tightening stops up on UNH. It's pretty beaten up intraday. If you take a look at a 2-hour chart, uh, it's been beaten up. But I mean, even looking at this 2-hour chart, I'm looking at this and saying, man, this is not good. I would be the least bit surprised to see us break to new lower lows here versus last week. So I'd be very, very cautious with UNH. If you have profits and you're overweighted, think about booking some profits. You could always get back in at lower prices. Just make those profits real. If we hold last week's lows, then I wouldn't do anything. I would just wait for this to trade sideways and see what happens. So that's UNH in a nutshell. I have been bullish on it. I think rightly so. But right now, the technicals are not wonderful. And we're threatening a breakdown here. So we've been long of it since back here. And we're not going to let those profits go to, we're not going to let a profit turn into a loss. It's not going to happen. So we're going to make some of that profit real. We have a pretty big position now because it's increased in value so much. It's time to trim. I had put a price target of between 330 and 335. We got up as high as 328 and then it pooped out. So that's my take on UNH. Okay. All right. We have a bunch of other folks. Talon, ROST. Let's get all of these off. Okay. Weekly view. I don't like it. Couple of reasons. One, momentum is horrific. Both lines on Stokes trading down below 50. And again, as I always like to say, rallies tend to fade. What happened last week? The rally faded. There's your upper band of resistance. There's your lower band of support at around 125. So it looks as though we're in a descending triangle formation. If we were to break out, I would get long. If we break down or do nothing, I would avoid it. But I would wait for the breakout above this upper band of resistance. It is declining, so it's going to change. But right now, it's at about 132 per share, but it's declining. That's going to change each and every day. So I'll throw this chart out there so you have it. There you go. Let's check out seasonality. You have well, it's got 40 years worth of data. Sometimes that's a little bit too much. Let's go to 2000. For the next few months, it's a coin flip which way Raw Stars goes. That all changes in October. If you see the stock get beaten up in September, I think you could buy it and ride it for a rally into the beginning of the year. Let's see if the insiders are doing anything. They're being awarded and they're not selling, so I guess that's a good thing. So no insiders selling, but no buying. Let's go to a daily view. Yeah, you hit that fractal resistance level. It broke out on the second, retested on the third. Again, it's got to break out above that 132 mark. I think that's the number, 132. Close above that mark, then I'd be interested in revisiting the chart, not necessarily buying the stock. Up volume, well, it was the abbreviated day, so we won't talk about volume. SoFi. Great chart. Let's get rid of all of this. Great chart. I think you're going up to about 23, 24 bucks a share on SoFi. So on a percentage basis, that's still a pretty good move on the stock. And on a daily time frame, this looks good for a continuation breakout. Let's overlay the automated trend lines. Not much to talk about there. I think that this is moving up higher. This is your price target right up here. It's rising. So 23, 24 bucks a share. I think that SoFi goes up. For Franklin, CCJ, Cameco Corp. Oh, that's Franklin's favorite. I got to tell you, it still looks good. This is a daily chart. Let me go to the weekly chart. I don't want to break discipline. Looks good. I mean, we're holding above this resistance level. It's respecting the rising lower band of support. Daily view. I think this is probably going to break out. Great price action, light volume, though, on the 3rd. But it looks as though this stock wants to move up higher. Bullish. URA. Struggling here. We've stopped going up. I've gotten so many mosquito bites. I've been working outside a lot. Okay, so it's consolidating at best. Am I a buyer here? If I wouldn't add more to a position, might I nibble? Maybe. Small. But if we break 37 bucks a share, it's probably going to move measurably lower. We've stalled out here. We're not putting in new higher highs. Daily charts. Stokes are clearly going into correction territory. We're just barely holding on to these automated trend lines here. I'm not a buyer. I think it's had a heck of a run. I think it's going to probably pull back further on that pullback, perhaps down to support here, 34.50 around there. I would re-entertain the trade and possibly get long. Goddamn, more mosquitoes. So URA, I'm a little bit more cautious on. CNC. Oh, isn't this the insurance company that caused UNH to go down? Yeah, it is. Okay, so I can only give you a couple of wisdoms here, okay? And then I'll talk about the technicals. Weak stocks tend to get weaker. Simple as that. So in all probability, we are probably going to move lower longer term. We have a 3rd standard deviation Bollinger Band here. We're trading down below it. Would I be surprised to see a pop? No. But they're probably going to sell that rally. They pulled guidance. That's never good. Here's the weekly view. If you get a rally up to 39 bucks a share to retest this prior support level, I would ring that bell in a heartbeat and get out. If it closes back above it, consolidates, you could always buy back into the stock. If you have to pay up a couple of bucks, so what? Right now, this stock is in a world of hurt. It's being sold by institutions as measured by volume. I'm not a buyer here as an investment yet. To do that, we would need to pull back to a monthly chart and say, okay, where might we have support below? And before we talk about that, I want to tell you right now, this chart has been signaling for a while now that there is trouble out there. Left shoulder, head, right shoulder. Here was the 45-degree neckline. Boom. This topping action right here should have told you all you needed to know. We broke support, check back, unable to recapture, failure. This was being signaled for the past, 8 months that this is probably going to happen. The markets send you signals. This was a signal. Get out. The trend had changed from up to now down. I'm not a buyer here. Where would I entertain buying the stock? This is the Fibonacci retracement tool. I think we're going to need to overshoot this retracement level at 28.20. And probably if it gets down here, I screwed that up. To around 27 bucks a share, then I would buy. Not until then. That's where I think it's going. As a matter of fact, I bet you a nickel that's where it's going. AMD. Oh, I got to really clean this up, man. Holy cow. A lot of these charts I haven't gone over in a long time. They were high flyers and they fell off the radar screen. Let's just now clean all this up, start fresh. AMD, a little stealth rally here. I hadn't been watching this. So far in the month, an inside month. No new high, no new low, but it's early. Good week last week. Yes, we closed down. But the prior week, we broke through fractal resistance in green. And we closed there. And last week, even though we closed down and didn't break out to new higher highs, we held that support level. Resistance is right at that 61% Fibonacci retracement mark, 62%. So I think it's a watch. I think it's probably going to move up higher. But just keep in mind, semis are all-time high. Everything's very expensive right now. I have to say that. I'm sorry. But it looks as though this may want to press up higher. If we break down below 132 per share, I would avoid it. Let's go to the daily view. Not much happening here. Not exciting. Avago, it's another one we haven't gone over in a while. This is a different chart. This is a bit more interesting to me. I think that we do. This is a weekly chart now. I think that we do go up higher. But man, what a rally. I'm going to put a price target of 315 on AVGO. That's where I think it's going. Daily view. Bullish reversal bar on the 3rd. I think it's going to probably break out, move up higher. Bullish on AVGO, a little bit more conservative on AMD. And that, my friends, you're welcome, Tim. Franklin, thank you, sir. Thanks for being here. Thanks for everything. Folks, thanks for being here. Like, subscribe. You know the deal. And everybody have a profitable trading week. I will talk to you soon. Take care and be well.